Hello and welcome to this very special episode of Crystal Ball, a show that we do periodically at turning points in the market to just get a handle on whether some bigger trends are emerging. The trends in the Indian market have been very ominous, to say the least. While a handful of large cap names have kept the Nifty afloat within 10% of an all-time high, underneath there has been such decimation that a very large number of mid-caps and even large cap names are now trading at below 2008 lows. Are there the first sniffings of a bear market situation out here? My guest today on the show, Shankar Sharma of First Global. Shankar, thanks for joining in. Does it look like something more ominous than just a routine correction? Could we even be at the early stages of a very bearish kind of patch for the market?
Yeah, I think the last time we met on your show, which was I think around budget time, I had held the view that we are at the cusp of a major bear market, and events subsequently have not made me revisit my view at all. In fact, from the beginning of the year, from early January itself, we have cautioned all our clients repeatedly that this year is going to be very different from last year. Last year we were table thumping bulls right from the month of January 2012. But in January this year we reversed our view completely. It's the complete U-turn. And so far the script is playing out, probably even a little worse than what we might have expected. But when you have the beginnings of a large bear market, then go back to 2008 January. You remember how it started. It started out being really ugly, and then the whole refrain started to come out that the worst is over. It's a healthy correction, and rubbish like that. It never quite happens that way. When you have significant cuts of the kind that we witnessed now or in Jan 2008, you should almost as a rule of thumb take it as something portending an even more ominous next few months.
Your views in January were sounding very cautious, but not outright bearish. What you're saying right now is that maybe the trend is accentuated on the way down, and certain facts have come to the fore which make you even more convinced that we are entering a bear market. What are these facts or signals that you're picking up?
Well, for one, we look very closely. At our hearts, we are really tape watchers. And, and when you watch the tape of how India or the emerging market pact has been behaving versus the US, that was telling you adequately that there is something wrong in this whole emerging market growth story theme. And, just go back to 2007. It's almost a mirror opposite of what happened in 2007. The US markets peaked in the month of September end, or actually October 1st week 2007. But emerging markets kept rallying on, continually till December, early January for India, and as late as April for China and Brazil. That's the kind of twilight zone in which people say, okay, the US has got a subprime problem. Emerging markets have got great growth still behind them. India, remember, was growing at 9% then, or 9.5%. China was 13% back then. So these countries there was something called a decoupling trade, if I remember correctly, right? I'm sure you recall that, and must have heard many experts talk about how EMs will decouple. As we now know, nothing decouples. Everything is correlated. Everything falls. Some might fall before, some might fall later. This time, it's exactly the opposite. EMs started to correct in January. US market is still not corrected. So people are now saying the reverse decoupling theory, that the US will carry on. The EMs are anyway a bunch of scam-ridden economies, so who should care too much about them? It never, unfortunately, works out that way. The US will also fall. The EMs have already started falling. So when you put that together in the backdrop of very poor economic data from almost all the BRIC pack, and of course, the smaller countries like Philippines, Thailand, etc., have had great runs, but that always happens in a pool of 15 markets. You will have the smaller markets doing well, the larger markets underperforming, as the case has been in case of EMs. Put all that together, and also the fact that Europe has not gone away. Japan, which was a somnolent market, had a vertical rally, and vertical rallies always end badly. So I have no doubt in my mind that Japan will also end very, very badly, because nothing really changed fundamentally except depreciating yen. US seems to be sort of holding its head above water. I don't see that sustaining for too long. All of that started from the middle of January. India started to crack, I think, from January 24th, if I'm not mistaken, and the EMs also around that time. And since then, it has been, an absolute one-way street for the markets. The budget, if you remember in the pre-budget show, I had said that, if at all India has any chance, and I'm not a big believer in budgets changing the course of markets, but if there is any chance that we have, I think this is the only chance we have, which is that Mr. Chidambaram gives us something to sort of live off for the next 6 or 8 months' time. Unfortunately, we didn't get any of that. We got a rude shock in the form of the tax residency certificate being no longer just a necessary and sufficient condition. It was changed very, very subtly to being necessary but not a sufficient condition for FII flows, despite the headlines in the budget speech being that we want to attract global flows, we want to be perceived to be an attractive destination through stable taxation policies. That was the headline, and here in the subtext you give investors something which completely removes the Supreme Court ruling on this matter many years back, that the TRC is enough proof for your residency in Mauritius. You completely remove that. All those things coming in already a very terrible macro situation. I don't, for the life of me, understand why bureaucrats or ministers don't see it from the eyes of a foreign investor. Pranab Mukherjee made the same mistake in a different form. I think Mr. Chidambaram done exactly the same mistake again in a different form. All that put together, I don't see where the big earnings upside in the markets are. I don't see where the big macro upside in the numbers are. I mean, if you look at anecdotally, I am Ahmedabad, I am Calcutta are unable to get their placements done at all or easily. I mean, that is telling you something. These are marquee institutions, and they churn out maybe, 300, 400, MBAs a year, which, if you're talking a $2 trillion economy, you should be able to absorb them in like a minute, which is to the case. Here, if they're having trouble placing people, that is telling you something that, there's a lot that is wrong on the ground now. It doesn't take a rocket scientist to figure out, therefore, if the markets are at highs or near highs, where that market is going to go. Is it going to take out highs conclusively, or is it going to fall short again in a third attempt, I think, after 2008 to get past the highs? Put it all together, that's the line of thought that we have had.
Does the breadth of the market worry you as well, Shankar? Because 20 stocks have held the index up, but mid-caps have already had a bear market of their own. Do you now see these large caps also following what has been going on, the bloodshed in the broader market anyway?
Absolutely. I mean, we watched that very, very carefully. And, that was apparent in the first fortnight of January itself, which is one of the key indicators we looked at and alerted clients on. Those kind of markets end badly, and it's just that the index is still not telling you how bad the situation has been, because the banks have held up. Tata Motors was still okay. Reliance was fairly stable at 820 to 850. So those are the stocks that were making you look good. But now the large caps that are beginning to give way. Mid caps have already lost all that they could lose. But the large caps have still a long way to go down, and that's, I think, the beginning of that you saw today.
Fundamentals have been rotten for quite a while in India, Shankar. The only thing is that we were getting a few $1 billion every month, and that might have cushioned some of the fall till an extent. But given India's recent underperformance, do you think we are vulnerable to some of the money coming off now?
I would think so. The only thing I always say is, you're right, absolutely right. We have been cushioned because of ETF money flows. You talk to the country fund manager, they don't seem to be getting any money. But the ETFs, do keep pouring in large quantities every month. But, clearly that's a momentum-driven sort of strategy that is followed through the ETF route, and that can reverse very quickly in theory. In practice, I doubt if they can sell more than $1 billion and not have a limit down day 2 days in a row. I mean, India is a very nice market. Our policymakers have made it such a beautifully shallow market that here a punching error by a broker can send the market limit down for, I think, 600 crores of trade. I mean, that's like $125 million, boss. I mean, if you're talking $1 billion out of, God knows, 30 billion last year and cumulatively $150 billion, this market won't open for 25 days. I can guarantee you that. Look at the cash market volumes. I mean, I think cumulatively between BSE and NSE is like 10,000 crores, maybe 12,000 crores, something of that. So that's like $2 billion a day. I mean, how can this market take $1 billion of selling? And so all you need is a single $1 billion. This market will be limit down. Every stock will be down 20 to 40%. And then the FIs will be forced to rethink that what's the point of trying to sell, because by the time you finish, it'll be down 90%. So why shoot yourself in the foot? Let's just stay put and keep buying more, or not buy, but at least not sell. So we have made a very nice market where you can only buy, but you can never sell. And it suits us as a country, and we should never try to change it.
What is your sense of how vicious this bear market, as you're defining it, could turn out to be? Because sometimes bear markets are not very deep affairs. The market loses 20-25%, it lasts for 12 months, and then you see a modest uptrend again. This variety, do you think it's going to be a vicious one?
I think if you choose between varieties of snakes, you have the anaconda and the python, which are relatively benign, they can crush you, but very slowly. Or you will have a viper who will sort of, make you die a very, very painful death. I think this is more the viper. I don't think this is a slow death. It is going to be a very, very prolonged but very painful. It's not going to be a easy drifting down kind of bear market. I have a very bad feeling about this one, because I don't see the macro numbers improving. In fact, I think there is room on the downside for macro numbers to disappoint, even from the 5%, 4.5% that we have been printing lately. And I don't see any pickup in earnings next year. Just a simple anecdotal point, boss. I mean, banks are contributing like 30-35% of the earnings growth of the Nifty for next year, and 60% in FY13. So 35% in FY14, 60% in FY13. I don't think banks are going to be able to deliver those numbers at all. You cannot have a macro situation being so vicious to any kind of lending, be it retail lending or corporate lending, and still expect banks to keep growing earnings 20-25%. I mean, that's absolutely absurd thinking. So I have no doubt that banks will disappoint. I have no doubt that the earnings number of 10 or 15% growth that we are penciling in for FY14 will not come through. I mean, all you need is disappointment from the big four banks, and you will be talking about like a low 5%, 6% kind of earnings growth. And if you also factor in the auto companies, which have been the other reasonable driver of earnings growth, and looking at the way Bajaj Auto is doing, I mean, I have severe doubts whether they'll be able to add value. I don't think Tata Motors can incrementally add value to the earnings growth. If anything, you're looking at a decline. So where is this earnings growth going to come from? I mean, definitely not from Tata Steel, for God's sake.
The refrain from the bullish camp, though, Shankar, is that this is the trough. It is the worst quarter. It looks terrible, but it will start improving next quarter onwards. You wouldn't subscribe to that view, would you?
Well, we all have jobs to protect. So, if you start talking the way I am talking, then this industry will shut down, which anyway, I think, it's headed there. I think people speak more out of sort of their personal biases regarding their personal lifestyles more than speak neutrally. And fortunately, I don't owe my lifestyle anymore to the market. So it's okay. I can afford to be neutral. My sense is it's not going to go away easily. I'll be happy to be proven wrong, but I doubt I will be.
No, the other dichotomy that we've been talking about for many months now is how retail or local investors have stayed away completely despite the 2012 up move, while FIs have continued to put in money. On hindsight, do you think retail will be vindicated?
Absolutely, without any doubt. Again, it's been one of my theories that if India has to truly become a very rich economy, the only way it can become so is if it prevents local investors from investing in our stock markets, and it makes it very easy for foreigners to invest in our stock markets. If you were to make that happen through policy, you will have the makings of a mega windfall for the Indian economy. I think without even realizing that, our policymakers have done that. Through the sales load abolition by a gentleman called Mr. Bhave, a few years back out of SEBI, he's prevented sort of large-scale sales to local investors. And by the liberalization of the FII side, where even individuals can come in and invest, because we need a current account deficit to be funded, it has created a situation which almost all the stock ownership goes to foreigners, and that's sold by the locals. At the end, in the stock market, everybody has to lose, or the majority lose. Let's put it this way. That's the more accurate statement. So if the majority are the foreigners, they will eventually lose. I mean, there is no doubt about it. That's the normal statistics of the market. So if they are disproportionate owners, markets will crash sooner or later. They will drop $50 billion in India. India will be richer by $50 billion. And that's the way India is going to suddenly get $50 billion of windfall. That is the only model in which I see this, this entire policy framework making sense. So local investors have done a great job. They have not bought into the bullish statements that brokers like us keep churning out periodically. They stayed away, they bought real estate, they put into bank deposits, they have bought gold. And if the markets are like this, I'm pretty sure the currency also will take a hit. So even though the dollar price of gold looks under pressure, I think the rupee price of gold may well be actually fairly stable to compensate for, because of the rupee depreciation. So overall, asset allocation-wise, the locals have done pretty okay. I mean, really can't find fault with that.
How do you position for a market like this, Shankar? The key sectors which have held out have been IT and private banking, and smaller sectors like pharmaceuticals and even consumer. Do you think those will crack as well?
No. Okay, out of the four you mentioned, I think banks overall we are very negative on, extremely bearish, and that is without exception to private or public sector banks. Both have a little bit different reasons, but broadly they fall in the same category. Both are over-owned sectors. We don't like sectors which are over-owned in general. And in case of banking, the earnings expectations are irrational. Going into a very slowing economy, you can't expect banks to stand out and make a lot of money while other sectors are hurting or the consumer is hurting. I mean, it's almost like the tech boom of 2000, wherein, we expected all our tech companies to keep posting record earnings while their end customers, be it the telecom companies and the banking and financial services companies in the US, or even locally, Tata Motors, Gujarat Ambuja Cement, they were all hurting like crazy. But we still expected Infosys and Wipro to keep blowing out the numbers. But they are service providers to these companies, just as banks are service providers to, manufacturing and other areas of the economy. So you can't expect those areas to be hurting while their service provider keeps making hay. So it's the same irrationality, and the most interesting thing is now nearly a third of the Nifty is comprised of by banks. This is again eerily reminiscent of 2000, wherein I think about 50% of the market was accounted for by four stocks, which was the big four ITs, and then you had Z, which was the fifth one in the TMT pack. So we have again manipulated the index in a manner that now you have a disproportionate weighting of financials in the index. And the same was true in 2000. So each time any sector becomes a disproportionate weight, it becomes over-owned. And that's the way the story always ends, boss. I mean, this has been there for the last 100 and will be there for the next 100 years as well. And I haven't made these rules. Those are the rules of index manipulation.
So where are we going with the levels, Shankar, you think? From this 18,500 kind of Sensex levels, do you see, say, 16,000 this year?
That would definitely be on the cards. I mean, the only saving grace will be, again, we are back to the bear market defenses, the ITs, the consumers, and the pharmas. I mean, those are broadly the areas where you will at least, save some money. You will definitely not save everything. You will still have to drop money. In a bear market, you always drop money here and there. But otherwise, I think on the traditional economies of your the metals, the manufacturing part, capital goods, banking, infra has been obviously a favorite shot for the last 5 years for us. If we only changed our view last year when we thought they'd corrected a lot and we would play a rally, and we played that rally in Larsen, in JP, etc. But nothing fundamentally changed in our view that we think is still a trash business. So I can only see trash businesses around. There are not that many good businesses that I can buy right now. So we stick to, again, the whole wheel shifts back to the defenses. And I think in defenses there are maybe 15, 20 stocks where you can stuff your money into and hope that they don't fall too much.
Earlier you were bullish on autos, but they seem to be going through a really rough patch. Is there anything that you would buy there or just stay completely out?
Well, I mean, Tata Motors has been a favorite for the last 3 years because we were the first to spot the turnaround in JLR even when the numbers were still $1 billion loss. But we've changed our view in the last about a month. Just a shade before we really started to see big downward movements. And of course, there were a lot of bullish reports coming out from foreign brokers, which is always a good sign to short a stock, including the market, which was very consensus negative in January 2012 and very consensus positive in January 2013. So if you do nothing else but except follow that, I think you would be making a reasonable amount of money. So autos, again, they've run a long way. They've been the single best performing sector from the 2008 January era. But I think it's time to sort of bid them a moderate farewell. I mean, not forever, but I just think that they are really in rough weather just now for the next few months.
But you're clear that this will be a global equity bear market. It's not that few markets in the emerging space will be singled out for some extra punishment while other markets continue to outperform like the US.
No. This is going to be global. This is going to be a repeat of, it's a hybrid between 2008 and 2011. So I don't think it's going to be purely 2008 because I don't think you're going to see a Lehman again happen. But things like Cyprus are no less worse than a Lehman, and it's very, very ominous what a Cyprus represents, and it's pretty horrifying if you think about the implications of another country going bust and then making the senior bondholders and the depositors pay almost everything away. So you're already beginning to see what could cause this 2008 or 2011 repeat. And remember, it always starts out small with an innocuous market. This is the strange thing about markets. Subprime started, people say just 0.5% of the national mortgage market is nothing. It's just it's a nothing problem. Then Iceland, happened, a few months down the road, and then you have now Cyprus happening. If you go back to the Asian crisis, I think the first one was Thailand, which was again a tiny little economy at that point in time. People say nothing, boss, it's okay, and then the contagion spread. So this time again, my gut feel is that Cyprus is not isolated. It will lead to other countries also doing a rethink. And there are many countries in Europe still which have outsized banking sectors relative to their economies, and that's a big problem. Malta is another one. I mean, you have like the banking sector being like 7-8 times their national GDP. So you can see why it's going to be a global bear market and not just an emerging bear market.
Shankar, thank you very much for your time. Good talking to you as always. Thank you.
Sure, Dian. Thanks.